across the globe, it's a story. I mean, I want to show you this chart. It shows the global supply of bonds that yield below zero is 10 trillion. That is almost near the record we saw back in 2017. What do you do?
That's a good question. Ultimately, this comes down to obviously the price for uncertainty, right? So, in the stock market, we're seeing this through a falling PE. I mean, the PE is still relatively high in the U.S. at 16.3 times forward earnings, but in the rest of the world, it's 12, 13, maybe 14 at the most, and so investors are pricing in uncertainty, and they're doing that through the bond market. The bond market's now putting the Fed firmly on notice that it needs to cut rates, and whether the Fed will comply or not obviously remains to be seen. But so we're seeing it in the bond market, we're seeing it in the performance of, let's say, utility stocks or other bond proxies, and we're just seeing it in a general derating for equities around the world. And that is the price of uncertainty, and we live in a highly uncertain world.
So you raised the question of valuation of the U.S. stock market at the moment, and in your notes you have an interesting point, which is it depends on what you really compare it with. When you look at total cash yield, it is much more modest, actually, historically. Now, we're putting up a chart right now that we borrowed from you illustrating that. Talk us through that.
Yeah, so the bearish argument is that we have all this uncertainty, and valuations are high, and that's kind of a toxic combination. And the valuations in the U.S. are much higher than the rest of the world. The MSCI All Country World ex-U.S. index is trading at about a 13 multiple, in the U.S., as I said, at 16 plus. But the U.S. has a unique phenomenon in its stock market that almost no one else in the world has, and that is that the U.S. is generating a lot of free cash flow. And even though the dividend yield is obviously very low at 2%, whereas it used to be 5%, if you add in sort of the yield, it's not a direct yield, but if you add in the cash yield of buybacks, which last year totaled over $800 billion, you get to actually 5.2%. So when you compare the market's valuation on a total yield basis versus a PE basis, you get totally different results. On a PE basis, going back to 1900, the market ranks at the 85th percentile of all valuation, which means it's only been more expensive 15% of the time. But on a cash yield basis, it's only at the 28th percentile, which means it's been it's almost as cheap as it tends to get.
Yeah.
And that's something that the rest of the world doesn't have. And so that's kind of the bullish counter argument to this notion that PEs have to come way down here.